morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, it's been a pretty rainy few days so far, but things are looking up in the business world. And today we're taking a look at two Canadian-owned banking giants listed on the Trinidad and Tobago Stock Exchange. We're talking about First Caribbean International Bank as well as Scotiabank Trinidad and Tobago. Now, both companies would have reported improved earnings. Let's take a look at why that would have occurred and what investors can expect in the coming months ahead. Turning firstly to CIBC First Caribbean, well, the company would have reported an earnings per share figure in TT dollar equivalent of 36 cents, which is a 60% improvement from that 22 cents reported in the prior comparable period. That is the 6-month period ended April 2021 versus April 2022. Total revenues were up, which is a very positive sign, up 7.4%. From 1.74 billion TT equivalent to 1.868 billion. Operating expenses were actually modestly lower, from 1.277 billion to 1.268, and there was a reversal in credit loss expenses on financial assets, reflecting an improvement perhaps in credit conditions generally and investment conditions generally, which is another positive indicator. And overall net income attributable to equity holders improved from 346 million TT equivalent to 560 million for that comparable 6-month period. Now, when we take a look at revenue composition by major operating segment or major business line, we can see that net interest income would have stabilized and is marginally up period over period, just 0.8% from 1.19 billion to just about 1.2 billion. And it has really arrested that trend of declining interest income that we would have seen over the past few comparable periods for First Caribbean or FCI. And operating income would have actually improved from 549 million to just about 668 million. So a fairly significant improvement there. And overall, that would have driven revenues up that 9.6% as we would notice, 7.4% as we would notice over those comparable periods. So from a segment of profit before tax by segment basis, we can see there was an 83% improvement in profits in the corporate and investment banking segment, from 360 million TT equivalent to just around 660 million. And wealth management and retail business and international banking, both of those segments would have swung from losses in the prior comparable period to profits of 42 and 36 million TT equivalent respectively in the most concluded period at 6 months ended April 2022. So at a price of $5 TT, FCI is trading at a price earnings ratio of 7.6 times, which is well below the banking sector average currently of 15.6 times, and does offer investors a very generous dividend yield of 5.4% compared to that banking sector average currently of 3.3%. It's also important to note also that FCI is one of those stocks that does pay its dividends in US dollars. So that's an added appeal, a very healthy and robust dividend yield based on recent dividend payments, and also the added attraction of receiving it in US dollars. So with improving revenues, attractive valuations relative to its sector averages, recovering dividend payments, and keeping an eye on financial market volatility, Bourse is going to maintain an overweight rating on First Caribbean International for the time being. Turning quickly to Scotiabank Trinidad and Tobago, SBTT, well, the company would have recorded an earnings per share figure of $2.02, 17% up from the $1.73 per share recorded in the prior comparable period. Again, its 6-month fiscal period ending in April 2022. Net interest income was actually down from 620 million to 599 million. Other operating income, however, would have more than offset that decline in interest income, or net interest income rather, leading to an increase in total revenue from 868 million to 952 million TT, 9.6% up. And there would have been a decline in non-interest expenses of 3.5%. From 373 million to just about 360 odd million. Overall, income after tax would have improved from 304 to 356 million. That's 17% increase as noted previously. Again, when we take a look at Scotia and its revenue composition, we can see that net interest income continues to decline over the past few comparable periods up to the fiscal half year of 2022 for the company, falling from 621 to 599 million. However, this would have been more than offset by an increase in other income moving from 248 million to 353 million, representing roughly a 42% improvement and contributing to that overall 9.6% increase in total revenues. Now, at a price of $77.08, which was its closing price on Friday, Scotia is trading at a price earnings ratio on a trailing basis of 20.8 times, which is above that banking sector average of about 15.5 times. And yet still, it still offers a fairly attractive dividend yield to investors of 4.7% compared to the sector average of 3.3%. With that improvement in operational efficiency, those increases in revenues and revenue streams, consistent dividend payments, but cognizant of volatile financial markets and above average valuations compared to the banking sector average, as mentioned, Bourse is going to maintain a market weight rating on Scotia for the time being. Well, that's it for this week's edition of the Bourse Report. For more information, you can give us a call at 226-8773. Email us at invest@boursefinancial.com and check out our website at bourseinvestment.com, where all of our research is absolutely free, and you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. Until next time, stay dry, stay safe, and we'll see you next time on the Bourse Report.